Hi there, everyone. My name is Nicole Glaros, and I'm the Chief Investment Strategy Officer at Techstars. Techstars works with early stage startups, and I personally have been an entrepreneur, and I have been mentoring and investing in early stage startups for almost 20 years. I've got a very large portfolio of companies. At Techstars, we have over 2,500 portfolio companies, and I was one of the first checks into DigitalOcean, so I have a soft spot in my heart for this company. But enough about me. We're here to talk about the when, how, and why you should raise capital for your startup. If I can change my slides. There we go. All right, so very first thing is you need to understand the different types of financings there are. The first type of financing is debt financing. Debt financing is pretty simple. It's what you get at a bank, and it uses assets in order to loan you capital. So debt financing is good because it's non-dilutive. You don't have to share in any of the equity, but it's bad because you actually need assets. And as a startup, oftentimes that's very hard. Also, it requires covenants and you have to return the money. So if the business fails, you probably have a personal guarantee. The next type of financing is actually called equity financing. So equity financing is what the venture capital community does, right? We invest a little bit of money in exchange for ownership in the business. And you don't need assets to do this. However, you usually do need a pretty good network, and yet you still need to return the capital. This is the part that a lot of founders and entrepreneurs get wrong. Investors are investing in you because they expect that money to get returned and then some. So please don't make a mistake in that you don't have to return it. But the other downside of raising equity financing is when you have partners. So oftentimes you'll get a boss. You have a board that could let you go if you're not performing. So, but the plus side is that you don't need to secure with your personal assets. But my favorite type of financing is called customer financing. And this is what startups often get wrong, or they forget about equity financing, or customer financing, sorry. Remember, customer financing is revenue. It's the thing that you're creating your business for. It's getting revenue off of your product, and it is the most repeatable and sustainable type of financing that's out there. Allows you to focus on what the whole point of your business is, and it's non-dilutive. You don't have to share in the ownership of your business. So as you're thinking about the world of financing and trying to figure out whether or not you want to do one, really think hard about considering customer financing. Bootstrap the business up so you can get revenue. By the way, there's an honorable mention to venture debt and revenue-based financing. Those are two other different types of financing, but a little beyond the scope of this talk. The type of equity investors that there are friends and family friends and family and angel investors. And these kind of investors are great because they believe in you and they want to support you. And they are motivated by returns, but they're really motivated by supporting you and believing in you. There's also, though, seed and venture funds, venture banks, private equity. These are sort of large, profitable businesses that really focus on returns. They're only going to put money into your business if they believe they can generate a great return for their investor base. A lot of times they're in it for the fame and glory, and every single VC I say that to hates me when I say it, but it's true. VCs are egocentric people, and they do this for the fame. Also, they're trying to protect their jobs, and they've got shorter timelines. It's really important that you understand the motivations of each different type of investor set, so you understand which type of investors are most appropriate for you to go after. Remember that when you raise equity capital, you are taking on a large responsibility to return it, and then some. I am so surprised at how often founders forget this. When you raise capital, especially if you raise capital from institutional investors, oftentimes those institutional investors, where they get their money is from pension funds. So I want you to imagine for a minute that it's teachers and firemen whose money is in your business. And when you fail, those teachers and firemen can't retire. So you're taking on a very large responsibility when you raise equity financing to return it, and return it with an order of multiple. So really consider that as you're thinking about raising. I want to do some really high-level return the fund VC math for you so you can understand what goes through our minds when we're making evaluations to determine whether or not we want to invest in a business. So first of all, you've probably heard the stat, 95% of all startups fail, right? So that means the handful of startups that do succeed need to pay back, and then some, all of the ones that have failed. So there's this thing called return the fund math, which means that every investment I want to make needs to have the potential to return the fund. And inside of a fund, you might have 20 or 30 investments. So each one of those has the potential to return the entire fund, By the way, if I do that, I've still failed because the fund hasn't earned money on top of the initial investment, if that makes sense. So that's why 20 or 30 positions, if one returns the fund, I've still failed as a fund. If two return the fund, I'm in a good spot, a 2x multiple, but it depends on how long it takes for that money to come back. If three return the fund, then all of a sudden I'm good. But three is 10% of a 30 position portfolio. And that's a big number given 95% of startups fail. So I want you to do a little math with me in your head, right? Let me give you a simplified example. If I run a fund and it's a $50 million fund, and I invest $5 million into a company, and I own 10% of that startup once I invest that $5 million, how much does that company need to exit for in order for me to return the fund? Right? Do the math. $500 million. So in my mind, as the investor, I'm trying to decide whether or not I think your business has the potential to sell for $500 million in a 5 to 7 year time frame. And as a venture investor, I'm going to be pushing you towards an exit like that, right? So just understanding that basic math will help you understand what venture capitalists, seed funds and venture funds and PE funds, what kind of math they're doing as they look at you. By the way, there's a whole bunch of caveats on that. We've not enough time to go through them, but it kind of gives you a sense of the mental framework when an investor is talking to you. So my question is, are you ready? Is this really what you want to do? Are you really ready to own a business and run a business of that size? Are you really wanting to be king, or do you want to be rich? Because if you want to be king, this might not be the path for you. If you want to be rich, it might be. Are you ready to step down or get fired when the investors believe that you're not suited for the CEO job anymore? Because when you raise this kind of capital, you're no longer in charge. You have a board and you have investors that you have to answer to. And they're not afraid to let you go if they don't believe that you can generate the kind of outcome they need for their funds. Are you ready to spend your days in board meetings, daily stand-ups, weekly all-hands, monthly check-ins, quarterly KPI evaluations, annual strategy meetings? I mean, this is what your life becomes, right? Not just about solving problems and supporting your customers and coding, but it becomes about administering a business. Are you ready to spend your time dealing with investors and employees rather than engineering our customers? All right, so just because you can raise money doesn't mean you should raise money. But if the glory and the fame is still outweighing logic when deciding if fame and glory is still outweighing logic, deciding when to raise is your next step. So quick update on timing of raises. So if you've got an idea or if you have a prototype, a friends and family round or a pre-seed or a seed round tend to be good for you. So that depends on the type of investors that you're going after. If you have some users or revenue, you can start thinking about sort of venture funds and specifically a seed round. You're probably still a little bit too early for a Series A, but maybe you might find an investor that would invest a Series A. If you've got revenue and it's growing at least 50% year over year, Series A is a great spot for you. But you shouldn't be thinking about Series B and later unless you know exactly what happens every time you put $1 into the business that generates $2 or $3 in revenue. If you don't know your business model yet to the formula to the T, you should not be raising later rounds. And you need to make the money that you do raise last until you learn that much about your business. Okay, so you've decided to raise. Let's talk about the fundraising process really quick. The fundraising process is 3 stages: the who, the pitch, and the close. And you need to master all 3 of these in order to be successful at fundraising. So let's talk about the who for a second. The very first thing you need to do is get organized, run a process. Remember, this is a sales process. This is not just a hey, introduce me to some people and I'm going to have some conversations, which I find a lot of founders want to do. Run a process and get organized. Start with a Google Sheet, and I'm actually going to give you an example of what that Google Sheet should look like here in a second. There's a lot of resources out there for where you could find investors. So here's some prospecting sources, right? Look at Crunchbase, look at AngelList, look at TechCrunch, look at PitchBook. literally Google it. Google how to find venture capitalists or how to find angel investors. And there are so many more sources of lists of names and venture funds that you can start to do your homework. As you find them, add them to that spreadsheet that we just mentioned. Now you want to filter down by a bunch of factors. Filter down by check size. So how much money do you think you're going to raise? What stage are you at? That will help you figure out how much money that you're going to raise, and then figure out, do they write checks in that stage? If they don't write checks in that stage, don't call them. Remember, time is your most scarce resource, right? Also by geo. Some investors only invest in a certain geo. So if you're not in that geo, they might not want to participate in you. They might not be interested in your sector or in your interest area. They might not be interested in how much traction you have. You have to find all of this out by looking at their portfolio and figuring out what companies that they invested in and when. Filter out ones that have invested in your direct competitors, but it's also great to talk to ones that maybe wanted to get into one of your competitors and couldn't get into the round, because that means they have interest in that sector. And lastly, make sure that you're identifying by the individual, not necessarily by the firm. So it's usually an individual that champions a deal through a venture firm, or if you're talking to angels, it's what that individual is interested in. So while it's okay to have firm name, you really want to go by each person inside of the firm. You want to identify 2 reasons why this person is a good fit, right? That because they invested in this other company, and this other company is similar to us, and that other company did really well and sold. Or, they talk a lot about this on their Twitter feed or whatever it might be, but identify the 2 reasons why you think that person is a good fit. If you can't come up with 2 reasons, don't call them yet. Categorize into an A, B, and C bucket. Your A bucket is the ones that are dream investors for you. Your B bucket is you'll take it, and your C is like only if I have to. And you want to start with your Bs. Don't start with your As. Don't start with your Cs, start with your Bs. You start with your Bs because they get you practice and help you work out the kinks before you get to your As. So go B first, then A, then C. Then share your Google Sheet with everyone you know and try to get at least 2 introductions, warm introductions to each person if you can. The first person will make the introduction for you. And we're going to talk a little bit about forwardable email in a second, but the first person will make an introduction. And the second person's job is to nudge that person a month later and say, hey, I heard you might have talked to so-and-so. I wonder how it went. That's providing a little bit of peer pressure. By the way, if you can't get an intro to these people, it's not the end of the world, but most of the venture community still operates on warm intros. So work as hard as you can to try to find intros to these people. Leverage LinkedIn, leverage literally your mother, whoever you need to call to try to find warm intros. And then use email use cold email as a last resort. All right, so this is kind of what your spreadsheet should look like, right? What's the person's name, the firm name, what check size do they write, why they're a good fit, 2 reasons, what category you put them in, A, B, C, who knows them, any notes that you found on the person, what the next action item is, and the last one is objections and requirements. So this is when you're talking to them, you're trying to find out what objections that they might have or what requirements they have of you in order to be able to make an investment. And I love putting this column in here because it forces you to ask those kind of questions, which will help you get to know them as an investor better and will also help you close the deal in later rounds. Okay, so that's the who. Let's talk about the pitch really quick. First of all, create a deck. I want you to Google Techstars Toolkit, or you can even just Google start a pitch deck. There are so many examples out there, but there's about 10 sections in a pitch deck that every single pitch needs. You absolutely have to have this. If you don't have this, I don't even look at the deck, right? Your pitch, your deck should be no more than about 12 slides, maybe 15. If you've got any more than that, I'm definitely not getting through the end. But make sure that you create that deck. Make sure that you're selling the investment opportunity, not the product. This is really hard for entrepreneurs to wrap their brains around. So you tend to come in wanting to sell your product and talking to me like I'm a user. I'm not a user of your product, although it's good if I want to be a user of your product. I'm a buyer of the business. So you have to sell me the business opportunity and why your business is going to 5x or 10x or 200x. That's what gets me excited, not just that customers are going to love your product, which is part of the equation. Get feedback on the deck multiple times before sending it out, and make sure that you're iterating on that, right? Get feedback on it, iterate, change it before you have final versions that you're sending out. Master the forwardable email. So make sure you have a really good subject line, make sure you have a really short email, and if you have to, attach the deck to it and send it to the contact, the who that that knows your target, that can forward your email. It's the best way to do it. Smart subject line, really short email about why you want to talk to this person, and the deck attached. If you Google forwardable email, you'll find some great resources there too. And iterate, I mentioned that. Make sure that you're interviewing the investor too. When you talk to them, make sure you're getting feedback on him and her, asking other people that they have invested in how it was to work with them, asking that investor, is this, trying to decide, is this the kind of person you want to be partners with? Is this the kind of person you want to have as your boss? And I mentioned this already, but start with your B group to work out the kinks, then move to your A group. You can have if you have a good deck, you will likely get a meeting. If you have a bad pitch, you won't get any farther. So make sure you're really focused on the pitch, and that you're practicing with people, and that you're getting feedback on it, and that you're iterating on it. It's amazing to me when I hear about founders that are walking in and have never actually given the pitch before. Stand up in front of your roommates, stand up in front of other founders. If you're part of any social groups, go pitch and get their feedback. All right. And then we'll talk about the close. So remember, we talked about the who, the pitch, and the close. The close is getting people to yes. How are you moving them through the process? Always be selling, right? So very first thing is you want to set lower targets and let demand push the total up. If you're trying to raise a pre-seed round and you come in with a $5 million pre-seed round on a $15 million pre-money valuation, and you don't have any capital committed yet, the likelihood that you succeed in raising that round is really low. What happens is scarcity breeds desire. The more that the less there is available, the more people want it. And so leverage that psychology to get your round done. So if you do want to raise a $5 million round, consider setting a $3 million target or a $2.5 million target. And when you get to that $2.5 million, then consider going higher. That way you can tell everybody, oh, I'm oversubscribed, I don't have any room left. And everybody feels really grateful if you're letting them in, or when you're talking to people, you're like, I'm not sure I can squeeze you in. It increases my desire to participate in the round. Make sure you lean into the ask. If you are married, or if you've ever gone on a date with somebody, you always lean into the ask. Would you marry me? Would you go on a date with me? I'm surprised when I see founders, they go, hey, so like, is this, interesting? No, lean into the ask. Make sure that you're making eye contact with them and say, is this interesting enough for you to make an investment in my business? What concerns do you still have? Make sure you lean in, look them in the eye, and ask that. The first third to the first half is the hardest. Once you get that done, you usually can get the rest of the round done. Learn to elicit the objections and then don't solve, rather reflect. As entrepreneurs, you've solved problems. This is what you are trained to do. But this is the first time that I want you to actually reflect on what you hear their concerns are. Don't try to solve them. So if somebody says, you don't have an office in the Bay Area, don't think that you need to move to the Bay Area to solve their problems. You just say, I think I hear that you have some concerns if we're not located in the Bay Area. Can you tell me more about that? The more that you can reflect rather than solve, they feel heard, and it actually makes them more likely to participate without you committing to doing something that you don't want to do. Make sure that you get an attorney that's experienced with venture deals. Please don't use your Uncle Bob. Make sure this firm has done at least 100 deals, if not more. I can't tell you how many companies I have seen messed up because they don't have good attorneys. If you can, find a lead. And what a lead is the person that sets the price and that writes the largest check and that does the diligence. When you have that person, you've got a person paying attention to the business, a person that's going to roll up their sleeves and get involved. And you want their expertise. For them, it's not just for you, it's not just about their capital, it's about their expertise in helping you grow the business. The least valuable thing that you get from investors actually is their capital. The most valuable thing you get is their expertise and their network. So if you can find a lead and somebody that's going to sit on your board and somebody that's going to help you when the business is struggling and somebody that's going to rally other investors around you, you're much more likely to succeed because you've got a lot of people rooting for you rather than some passive person that you just send an email update to periodically, then that they get in your hair when things are going wrong. These are opposite sides of the same coin, but one of the big summaries I want you guys to take away is make sure that you're running a structured process when you're fundraising, but also fundraising isn't a transaction. It is a relationship. People write checks when they feel comfortable with who you are and what you represent and where your business is going. It's building a relationship. So while I want you to run a structured process, I want you to build relationships with people in the process. Oftentimes they will pass on the first round or they'll pass on the second round and they'll participate in later rounds. Or oftentimes they'll pass on this business and they'll invest in the next business. But when you build these relationships, this is how that you can raise capital much more easily for not this company, but for future ones. All right, that's all I had for today. That's an hour-long talk that I just crammed into 20 minutes. It looks like there's some questions that popped up. So I can tackle these in the Discord channel, but I think I can tackle some of them here. How much revenue ARR do you need for a Series A? It varies per venture fund. Totally varies. So this is what you want to ask when you're talking to investors. Say, out of all of the Series A investments that you've done, can you give me a ballpark of revenue targets as those companies have had when you've made the investment? So turn it back around on the investors and ask. That will help you specifically identify what their targets are rather than some blanket number, which is going to be different from every investor. For the deals that you see per year, how much do you end up investing in? That's a great question. For us, it's probably 1% to 2%. And that's over the whole pipeline, right? So from like first outreach to final investment is probably somewhere between 1% and 2%. However, we're a little bit unique, so I wouldn't take that with a grain of salt, not appropriate for every investor. Can you share a link to the spreadsheet where the investors are? It's not a spreadsheet. So there are tools out there that will help you find the investors. So just go Google it. I don't have a spreadsheet for investors. That's up to you to build that spreadsheet to figure out what investors are most appropriate for you. Sounds great. The pros of fundraising, any cons? Yeah, the cons are you are either running your business or you're fundraising. You're not doing both. You cannot do both. And so this is why I encourage you to think hard and long about whether or not you actually want to fundraise. For many companies, it's not the right approach. The best time to fundraise is when you don't need the money. And of course, that's sounds opposite, but when you have a business that's working, it's not hard to raise. And then the investors are going to come in at whatever terms you set. But when the business isn't working yet, you're on their terms and you're focused on making them happy and getting their capital. It's a little bit like a drug dealer, right? I'm going to trickle a little bit of money out to you in order to make you reliant on me. So you have to keep coming back for more money. So I buy more and more ownership in your business. The best time to fundraise is when you don't need it. And because you're either fundraising or you're running your business. You can't do both. So I think that's about all we have time for. Sure about that? Maybe. Anyway, my name's Nicole. You can reach me at nicole@techstars.com. I do respond to all emails, although I'm slow on email, but I promise I will respond to yours. Techstars actually has a lot of resources for fundraising. If you just Google Techstars Toolkit, you'll see a bunch of resources, not just around fundraising, but a lot of elements of the business. And by the way, if you're considering not fundraising, there's a great book out there that's called Levers by a gentleman by the name of Amos Schwartzfarb that I highly recommend you reading. You can understand what your business model looks like and really figure out what the levers are of the business in order to get you to not have to fundraise. It's beautiful. Yep, thank you. They're telling me we have to wrap for the next section. I appreciate everybody's time and please don't hesitate to email me if I can be of help. Nicole Glaros out.